Hey, today I want to talk about one of my favorite ways to invest passively. It's in multifamily buildings, which means apartment complexes. And you don't have to be the landlord. You don't even have to set foot on the property. Hi, I'm Rebecca. Thanks for joining me on the Mama Lorian Way, where I like to talk about money. I believe that when we talk about money and we're open about things like that, we actually have more control of our lives and our finances. One of my favorite ways of investing is passive investing in multifamily. What this looks like is there's professional real estate investors that they go and find apartment buildings that might need to be rehabbed, which means value added, or perhaps it's a new build, and they need investors to come in with them just to put in equity so that they are able to purchase the property or get a loan on the property. I'm going to put my specs on because we're going to talk numbers. Just as a general overview, why would anybody need to have investors if they're looking to buy multifamily property? And these people called sponsors, they will find a property, and in this particular example, this property is being sold for or being bought for $48.3 million. These sponsors were able to secure a loan for $36.1 million. Well, that leaves a space of about a little over $12 million to fill. And just like any mortgage, like if you get a mortgage for your house, the bank's not going to finance 100% of the cost of the house. You have to put a down payment in. So this equity is a down payment. Well, in this particular example, and they're all different, the real estate company that's buying the property is putting their skin in the game of $1.2 million. So that's what they have to lose. It's good. They need to put something in for sure. This leaves an amount of about almost 11 million, 10.9 million that they need to raise from private investors. And that's where we come in to be able to sit in our armchair, invest, and not have to paint or deal with tenants or anything. And this is why the sponsors need people like us. They need to find a way to get that down payment, basically. And they reward us for trusting them with our money. Now, there's a couple of things. One, when you invest in an apartment building or multifamily, you're generally looking at 4, 5, 6 years of not being able to access that money. You may be getting a cash flow on it. You may not be. But over that time, you got to make sure that it's money that you don't need to touch for about 5 years. Definitely might be worth it. Little disclaimer, I'm on this site that I'm not going to reveal what it is because I think some of it's proprietary. But if you want to know what site I'm on, send me a message on Facebook and I'll kind of walk you through the process. There's 2 ways sponsors can make money on multifamily. And one way, they may buy a property that is basically like a fix and flip. It's something that may be a little run down and there's opportunity for them to do some improvements, some updates, and make the property worth more, get a little bit more rent, and ultimately sell it for a higher price because they've made improvements. The second way sponsors make money is that they may do a new build. They still need money. They definitely need money for the new build because they've got a construction loan, but they don't have any tenants bringing money in. So I like new builds, but the one thing about having new builds is you may not see any money until 2 or 3 years in. And that's okay because the upside after 5 years might be totally worth it. Well, let's look at this particular investment is a value add. So it's an existing building. The estimated hold period is 4 years, totally valid. And up here, this is how, and I'm going to make an aside, this is not due diligence. You need to do due diligence on your sponsors. You need to do due diligence on the property to make sure the sponsors are educated and experienced and that the property is where people would want to live. If it's like out in the middle of zero land, nothing around, you may not want to invest in a property. But if it's in this place is in Austin, people are probably going to want to live in it. 3 numbers here. Target IRR, target cash on cash, and target equity multiple. These are the numbers that you want to look at to see what your return for your money may be. And I've done a PowerPoint talking about this. So let's start with IRR. Target just means, by the way, target just means they're estimating. They're making a best guess of what the property is going to perform like in the next 4 years. So it's target. It's not a guarantee. IRR means internal rate of return. It's annualized, it's yearly rate of return as a percentage, including any distributions and appreciation after expenses. What? All right, let's just walk through. This is your total return. So it's the total amount that you realize, including your initial investment at the end of the investment period. Subtract your initial investment and then divide by the time. Then you take that number and you divide by your initial investment and you'll find out your internal rate of return. Let's make an example here. I'm doing kind of simple math. $100,000, we're going to say, is our total return. We're going to say $100,000 of what we got out at the end of it from cash flow, from appreciation, like when they sell the property and it's worth more than they paid for it, it's appreciation. You get a cut of it. Let's say in this example, I'm going to use throughout all these, we put in $50,000. So $100,000 minus $50,000. It's pretty easy math, but I'll still use my calculator. $50,000. And usually it's about 5 years, so we'll divide it by 5, is equal to $10,000. You take that $10,000 and you divide by your initial investment, and you get 0.2 or 20%. So that means that each year you have an average of 20% return on your initial investment. That's a target that we like to look for. We do like to look for about 20%, more or less in the ballpark, each year return on your investment, because it's been invested for a long time. You want to realize something good. Target cash on cash. Cash on cash. What's that? How much you're getting on your investment as distributions over a year. What? Okay. Calculate as a percentage of your initial investments, and it's net cash flow divided by initial investment. That means how much money you're getting distributed to you as the investor from the sponsors, from the income, the net income that like the tenants are paying in rent, maybe they're paying parking, maybe they're paying laundry facilities. After all expenses, there's money left over. That's cash flow. So you get cash flow depending on your initial investment. So say in our example, our initial investment was $50,000. In the example that we looked at on the website, 6% cash on cash would mean $3,000 a year is what you're looking at as a 6% cash on cash investment. What if you were getting distributions and you wanted to know what your actual cash on cash was? Well, you could kind of do it the same way, but a little bit backwards. Say you got $3,000 in a year and you had invested $50,000 in. You could do it 3,000 divided by 50,000 equals 0.06, 6%. So that's it. That's a nice way to know how much income you might be getting from rents received and other things, like again, like laundry and stuff. But it's not your entire return. It's just cash on cash each year. Going back, there's a third number. I'm going to scooch my down. Target equity multiple. Equity multiple. This case 1.73. Well, let's go back and look what an equity multiple is. It's how much your investment doubles or triples or whatever over time. So if it's a 4 times equity multiple, that means you're getting 4 times your money back. What your total return might look like, initial investment times equity multiple equals your total return. $50,000 times 2.0, 50 times 2 is $100,000. You could also get your equity multiple. So you've got $100,000. Let's get my calculator back. Say you after 5 years, your initial investment of $50,000 yielded in total $100,000. You could divide that by your initial investment. And you go, bam, 2. And you do, as a general rule of thumb, we are looking at investments that can double your money in 5 years. So that's a 20% IRR or a multiple of 2. I'm going to scooch down, and they do a hypothetical investment of $50,000. And again, just to see what this might look like, to have an idea of what returns look like. So in your first year of your hypothetical $50,000 investment, you might get a cash on cash of $2,500. And then they keep making improvements to the property, rent out the vacancies, maybe put in laundry machine, something like that. The next year, you might get a little bit more. Next year, maybe a little bit more. And in this case, year 4, they sell the property, and this is where the appreciation comes into play. You get $76,000 back. Now, for your total rate, you would add year 1 plus year 2 plus year 3 plus year 4 to get your total rate of return over 4 years. Let's look at another one. Now, this one is different because this is a new build. And they only have 2 numbers here, which makes sense because when you have a new build, you don't have anybody living in a property that hasn't been built yet. So you're not getting cash on cash probably for the first 2 or 3 years. Their target IRR is 18.2 with a range. So that's pretty close to our 20% that we're looking at to double your money in 5 years. And their target equity multiple, 1.88. Pretty good. Double your money in estimated time, 5 years. And if we scroll down, and I'm just doing these as examples, not saying anything you should invest in this property or not. So a hypothetical $50,000 investment, different than the other one, because in year 1, 0. The other one you had some money coming in. Year 2, minimal, but maybe they've started being able to get some renters in by year 2. Year 3, now look at this, $33,000. That's probably meaning that they are wanting to refinance and take some cash out after year 3, after it's starting to make money because tenants are living there. Year 4, now I have a cash on cash back because tenants are paying. There's a cash flow. Year 5, sale of the property. Some appreciation. You're going to have to pay back that cash out finance. So it's not the $76,000, but this one is kind of nice because you're looking at possibly getting a return earlier than your 5 years. All right, guys. I hope that was a kind of an overview. Take the specs off. What you might be able to realize as return on an investment as a passive investor. One more caveat: to be included in these sponsorship offerings, you need to be one of 2 kinds of investors. One is accredited. Accredited means your net worth, your family's net worth is $1 million or more, not including your house, your private residence, or you make $250,000 as an individual, $300,000 as a married couple for the past 2 years. That may have changed by the time you're watching this, so check. Or, this is the good news, you can invest as a sophisticated investor, which means you have educated yourself, you have done your research, you have done your education, you have done your training, you have built up your relationships with people. That's how I've done a lot of this. Built up your relationships with people so you understand what's going on and you can trust the partners. If you like what I'm doing, subscribe, comment, share, hit me up in the Facebook if you want to know a little bit more about this, and I will see you on the next one.